So Nigel, what are the challenges to pension plans and providers in engaging with DC plan members now that they have more decisions to make post-retirement freedoms?
Well, I think the first thing to appreciate is that levels of financial literacy around the world are incredibly low. State Street did a piece of research looking at both institutional and retail savers and investors around the world, and then we aggregated these scores to look at, if you like, a sort of country report card, around the world. And only one country got a C, and it wasn't a country in Europe. So the natural knee-jerk reaction, knowing that financial literacy levels are so low, would be, let's educate people. Let's try and get people to make better financial decisions by teaching them. But several decades on from trying to explain the difference between a stock and a bond to normal people, I don't think we're any closer to actually achieving those levels of education that perhaps in an ideal world we'd wish for. So should we engage people instead? Well, again, I think that's tricky because people are largely inert and, to be frank, somewhat disinterested in pensions, surprisingly enough. So perhaps the answer isn't engagement or education, and it's what we're starting to think of as ownership or responsibility. So again, recent research we've done in the UK about how people interact with their savings when they come to retirement seems to suggest that, together with the great distrust people have of the state and of the industry, this results in them not really feeling that the money in a pension plan is their own until they reach into the insurance company or the asset manager and pull the money out and put it in their own bank account. But this is obviously quite disastrous because all of a sudden you lose the tax advantages and the investment advantages that you would have had you left the money in there. So what we're trying to engender is really this sense of responsibility and ownership to say, yes, I can't touch the money for a while, and maybe I don't want to learn about it, and maybe I don't want to engage with it, but it's mine, and I have some responsibility for making sure that I treat it as such and save more money and deal with the proceeds responsibly once we get to retirement.
How do asset managers have to adapt their models to take into account the fact that the default funds that savers go into early in their careers can now have a much more significant impact on their ultimate readiness for retirement?
Well, I think the first thing we have to think about is that post-freedom and choice legislation in the UK, there's now 3, possibly 4 different things that people can do at retirement. In the old world, sort of pre-freedom and choice, 90% of people bought an annuity. In the new world, 90% of people won't. And the things they can do instead, as well as buying an annuity, they can take all their money out as cash, and that might be appropriate under certain circumstances. They can remain invested and draw down money, or they can do a combination. So there's 4 different options. Now the question is, can we set people up in defaults prior to retirement to have a pathway to one of those different outcomes? And this is flawed, this is difficult, and I'll tell you why. Again, research that we've done suggests that only about 60% of people can pin down with any degree of accuracy when their retirement will be within, say, a 5-year window. And only 16% can plan more than 10 years ahead of that date. So you have people who don't know when they're going to retire, don't know how they're going to retire, and don't even know the route to get there. So trying to put in place a default with all those different variables is incredibly difficult. At State Street, we believe that the best option for most people is a keep your options open fund, if you will, one that's volatility managed so that if you decide to take cash or buy an annuity, the value won't fall in a given day, but also one that keeps some growth on, maybe risk assets to 40 or 45%, to make sure that if you do stay invested, then you have got some long-term growth potential. So again, we think this compromise approach is probably the best for most people because life is complicated and it's really difficult to plan ahead.
How much more important now is advice and also less formal, less regulated guidance in preparing savers for retirement post-freedom and choice?
Yeah, this is a tricky one. I mean, if you think about how people are treated within the accumulation phase, the savings phase of DC, then they're typically in a low-cost, well-governed, light-touch, non-advised default world. And people like that because of the inertia and the lack of interest, really. But then unfortunately, when they get to retirement, we tend to throw them into a world which is the opposite of that. It's typically regulated in terms of advice, which means it's heavy touch, which means it's expensive, which means it's complicated and possibly less well governed. And the sort of disparity between the savings phase and the payout phases is palpable. It's very difficult for people to cope with that. Now, we need to make sure that regardless of whether or not people engage with formal financial advice or guidance, they get a good outcome. And I think there's a really good case for having defaults in retirement as well as defaults in saving itself. But currently in the UK legislation, it's not possible to default people at retirement. So I guess the question is, if we treat people as a homogenous group largely through defaults in saving, can we get something that's more like a path of least resistance, something where people will get a good outcome even if they choose not to engage at retirement? And again, at State Street, we're working on solutions like that. I think currently there's some quite good things in place. So the Pensions Advisory Service, TPAS, is increasingly popular, and most people have a very good, reasonable outcome and a reasonable experience of engaging with TPAS. You know, advice is trickier because largely people aren't used to dealing with financial advice unless they've had a bequest or they're buying a house. You know, people don't know where to find advice. They don't know how to recognise a good advisor versus a bad advisor until it's too late. And although they say they're happy to pay for advice, when people actually find out the real cost of that advice, they go into a state of shock because it's quite expensive. So this is difficult. I mean, one of the possible solutions in an advised world is robo-advice. You know, something that's low cost, something that's repeatable, something that has less human touch but is regulated. And I think we're starting to see some interesting developments in automated or robo-advice which could, you know, get better over time.